All right, hey everyone, welcome back to the channel. So in today's video, we're talking about how the US flipped the euro, how it's basically breaking the euro. Right now, we're essentially at 1-to-1 for dollar to euro, basically parity there. And I want to explain why this is so important for you to understand and how this affects you personally, whether you're in the United States, you're somewhere in Europe, you're in Africa, Asia, South America, anywhere in the world. I'm really going to help you understand currencies, how they operate, what makes a strong currency, what makes a weak currency, and then how this affects your buying power. I think this is all very, very important to understand. Now, look, I'm not going to be jumping around on screen like every 3 seconds with tons of like cinematography and everything. I'm just going to be sitting here with this PowerPoint, and hopefully you don't hate that, and hopefully you don't get too bored. But I really, truly think that if you sit through this, you're going to learn a lot. You can carry this with you for the rest of your life. So let's go ahead and get deep into this video here. So here's what we're talking about in today's video. So first of all, we're going to talk about, yes, the parity. How does this affect you? We're talking about what makes the dollar stronger, what has been making the euro a lot weaker, like what specifically has affected that. We'll talk about Germany, their fuel prices, all kinds of other problems, the war with Russia, Ukraine, and then the pros and cons of strong and weak currencies, the big problem that the Fed is facing, and then my opinion on this, sort of what I think is going to happen in the future. Is the dollar going to continue to get stronger, and all of that fun stuff. Okay, so let's get into it here. So first of all, let's just understand quickly what exchange rates are, how they operate. So the foreign exchange markets, without sounding like one of those Forex people, watch out. There's like probably 80% of times when you hear the word Forex, it's like some scammer trying to get you to like buy their course. I have nothing to sell you. I'm not gonna like message you in the comments or anything, so don't get scammed. But the foreign exchange markets are much larger than anything else. Like they're larger than the stock market or the bond market. We see over $6 to $7 trillion flowing in the foreign exchange markets on a daily basis. So it's really large. But let's talk about kind of like what determines why is a dollar worth €1 right now, okay? And so it does come down to supply and demand. So for example, when there's higher inflation in a country, that generally weakens their currency. I think the inflation part of it's pretty straightforward. When you have lower inflation, it tends to strengthen your currency. Now, a lot of that also is dependent on the central banks, if they're raising or lowering rates. We'll talk about that in the next couple of slides here. But interest rates, central banks, they play a huge factor into strength of a currency as well. So for example, the United States, right? Jerome Powell, the Fed in the United States, he's been cranking up rates a lot faster than the European Central Bank and in like Japan and other places, in Turkey certainly. And so because the US Fed has been cranking up rates higher, faster than the other countries, this tends to make the dollar a lot stronger. And so basically just when you have those higher rates, you tend to have a stronger currency. Now also remember that as I go through this video, everything, because we're talking kind of about economics here, everything you have to take as a grain of salt. Nothing is 100% a fact. Like there are going to be things up for debate. For example, you could say that lower rates could lead to a stronger currency, and you could try to argue that point, and I'm sure you could make some valid points on that. But these are some basic things that drive exchange rates. Now let's continue on here to help understand this a little bit better so that we can understand why the dollar flipped the euro. Another one is, look, trade surplus and deficits can certainly affect exchange rates for dollars and euros and yen and any other type of currency. But another big one that I think people sometimes just don't really think about is actually public debt. So your debt to GDP ratio. The one that we can look at here, the one that's been affected significantly, is actually Japan, right? So Japan has a significant amount of debt. I think the government of Japan owns like 50% of the nation's debt, something absolutely insane. And so when a country has high levels of debt, it's just like with any company that has high levels of debt, they're going to be less reputable. They're going to have a higher risk of default, and so therefore it hurts the value of their currency. So this is why, like Argentina, for example, if I'm remembering this correctly, I think it was something like 3 Argentinian pesos to $1 a certain amount of years ago, and now it's something like probably closer to, I don't know, 80 to 100 Argentinian pesos to $1. And a lot of that is because their public debt levels have been very high, and so they've seen a lot of uncertainty, and this has led to a weakening currency, which then kind of creates creates this spiraling effect, which we can talk about Argentina in a full video later on because it's really interesting what happened there. And then overall economic performance and stability of a country, for example, Switzerland, right? People have always trusted Switzerland, and so therefore a currency in Switzerland is going to just have a certain amount of value. This is why the dollar has been the world's reserve currency since 1944, because it's seen as relatively stable. Same for like the United Kingdom with the pound, right? Countries that have had a long track record tend to have more stable currencies. And so yeah, that's what drives exchange rates, right? So those are some of the basic factors. Now let's try to understand why the dollar is getting stronger, why the euro is getting weaker, and how this affects you personally. All right, now before we get too deep into this video, don't forget to get your 10 free stocks on Moomoo using the link down below in the description. They're giving out so many free stocks today. I feel like every year we see brokers giving out more and more free stocks. It's pretty amazing. So go ahead, get started with Moomoo if you want to invest into the stock market using the link down below to get those free stocks. Right now it's 10. I don't know if they're going to switch it. They might lower it. They might increase it. I have no idea. So you might as well just go ahead and get those free stocks now while they're still there. So thanks, Moomoo, and let's continue on with the video. Okay, so first of all, the dollar, look, it's seen as a safe haven asset, right? Like I said, it's the world's reserve currency. Bretton Woods, 1944. We can talk about that in another video in itself as well, because that's a big, big topic there. But basically, most things are denominated in US dollars in the world. So if you're a corporation in Guyana and you want to raise money or you want to issue debt, in a lot of cases, that's going to be issued in US dollars because it's seen as a stable currency rather than a country's currency. Like going back to the Argentina example, you're not going to bring on debt in Argentinian pesos because nobody wants to issue it in that, so you do it in US dollars typically. So the US dollar, it's seen as pretty much a safe haven. And so why is the dollar actually getting stronger? All right, so it basically just comes down to, once again, supply and demand. So for example, the Fed's cranking up rate. We're seeing a massive inflow of money from places like Europe, where people say, I don't really trust the euro as much because we have war, we have all kinds of these other things, energy crisis in Germany, all these other problems. And then they look at the US, which has an extremely low unemployment rate, and they've also been cranking up rates, which then gives higher yields on US denominated debt. So like US treasuries, for example, even like the 3-month, or you can look at like a 10-year, and it's over 3% right now, which is a lot more attractive than if you're going to be getting some type of European debt that might be at something a lot lower, certainly a lot lower than 3%. So when you're looking at it and saying, well, if you believe that Europe and the United States are equally as stable of regions, well, you might as well just put your money into US because the bond yields are going to be a lot higher today because the Fed has been cranking rates higher than the European Central Bank. Also, I apologize if I'm talking too quickly or losing some people along the way. I hope this will all make sense towards the end because we're throwing out a lot of stuff here. But there is this saying that when the US sneezes, the world catches a cold. Basically, like I said, a lot of things run on the dollar. And so when things happen, like when the Fed cranks up rates, this squeezes a lot of other countries because most debt is denominated in US dollars. And so it squeezes a lot of these other countries, and it effectively pushes inflation onto the rest of the world, and Americans kind of get the better end of the stick and the rest of the world gets the shorter end of the stick there. But when the US sneezes, the world catches a cold. I mean, look at like the housing crisis in 2007. A big factor for the Great Recession that affected the entire world was because of the United States and the housing crisis. And that basically created this contagion all around the world. Now, there were certainly other problems. Don't want to make it sound like the US was the only issue there with the housing crisis, but that was one of the big effects, and it brought down basically the entire world economy with it because of mistakes that people made in the United States. But overall, looking at the current global environment, it's very uncertain. So we see that big influx into US dollars, right? So high inflation around the world, not just in America, but like I said earlier, the big difference is that in the United States, we have a relatively strong economy. And so we have, 3.5% unemployment. So the Fed can crank up rates. In Europe, they can't really do that because unemployment is already pretty high. And so they have less leverage. They have fewer options and basically less ammo than the United States Fed has to deal with things like high inflation. So that helps the dollar. Slowing global growth around the world. The war with Russia and Ukraine, I mean, it's the biggest war since the Second World War. And, if that's happening in your continent, you're going to be looking around saying, well, this does create some level of uncertainty. Even if we have NATO and all these other things, there's still a certain level of uncertainty and that's going to affect the euro and help the dollar. And, like with skyrocketing energy costs in Germany, and then also the increasing tensions with China and Taiwan, all of this has helped the dollar overall. Okay, so that's the basic reasons why the dollar is getting stronger. Now let's talk about why the euro is getting weaker, because let's look at the charts right here. I mean, we see that, if you went to Europe back in 2008 as an American, it would take $1.6 to get €1. So if you would go over to Europe with $1,600, you would get €1,000. Right? For $1,600, €1,000 back in 2008. Today, if you take a trip over to Europe as an American and you bring over $1,600, you're going to get €1,600. And so the exchange rate is a lot more better for Americans now. This is why one of the benefits there for Americans is to travel to Europe or travel abroad, because it's going to be, your money's going to go a lot further than what it did, 5 or 10 or like in 2008 when the dollar was super weak. It's going to go a lot further. Now, conversely, or on the other side, Europe, for example, if you have all of your assets denominated in euros and you want to go to the United States, it's going to be more expensive today than what it was last year. I went to Europe last year. I went to Spain, and it was like $1.2 for €1. And so my money didn't go very far. Now, let's talk about a strong dollar from the U.S. perspective. How does this help Americans, and then also what are some bad things about this as well? This is a big important thing to realize, because actually most people, when they think, oh, our currency is getting stronger, they think this is all good, this is all benefits, but there's actually some negative externalities from having a stronger currency that I think we should actually talk about, because it's not really common knowledge here. So like I said, you can travel for cheaper. You can also get cheaper imports. So if the dollar gets stronger, it's now cheaper to import, say, cars from Germany, or theoretically should be cheaper to import cars from Germany. Americans love their German cars, BMW, Audi, Mercedes. And so because in Germany, they might be making the cars for a certain amount of euros and they know how much it's costing them and they're selling them in euros, and now our dollar goes further. And so therefore it might be cheaper to import certain products into a country where your currency is a lot stronger than what it was previously. There are downsides to it though. For example, your foreign revenues are worth a lot less. I think it's something like over 30% of revenues from companies in the S&P 500, which is an index in the United States for equities. Something like 30% or more of revenues come from abroad, come from outside of the United States. So if you're a multinational corporation, say like McDonald's, and you're selling burgers in Turkey, where they've had, I think, something like 80% inflation over the past year. And if you're selling burgers in Turkey, well, people are paying for those burgers in that country's currency. And then because you're McDonald's and you report all of your money in US dollars, you need to convert that Turkish money into American money, into the US dollar. And so you're going to basically lose a lot there. And so this is what's happened. This is why I went short on Philip Morris, which is a tobacco company that gets a lot of their revenues from outside the United States. I closed that position, by the way, now. But it's an interesting play that you can make with foreign exchange and understanding exchange rates, that foreign revenues are worth a lot less. And the other downside to this that people don't realize is that when you have a stronger currency, your exports actually become a lot more expensive. So it's harder to export stuff because now your goods are more expensive. So if there's companies in the United States that export stuff to Europe, which I don't think there's that many exports that America has right now, but we certainly have things like, for example, fuel, right? That's a pretty big export. And so it becomes more expensive abroad, and so it's harder to actually export things like that because fewer countries can afford a country's products if they're too expensive because their currency is too strong. So those are some pros and cons of having a strong dollar. The other con of having a strong dollar or having a strong currency in general is actually it can affect your unemployment rate as well. Because you're going to have fewer jobs to go around theoretically because your exports can end up going down sometimes because it's harder to do that. So sometimes you can see an uptick in unemployment rates if your currency kind of spirals out of control and gets too strong. It has happened before in the past. Okay, so now let's talk about how does a strong dollar affect the rest of the world? How does a weak euro affect the rest of the world as well? So one of the good things about a strong dollar, let's say you're in Europe or you're somewhere in a country where your currency has weakened against the dollar recently. One of the good things is that you can actually export more. You're going to have better luck with exports, and overall, people should have more jobs And of course, like I said, this is sort of theoretical because there are a lot of factors that go into this. But it's one of the reasons why China, for example, kind of likes to have a weak currency because this allows them to continue to be a net exporter and to really help their manufacturing business. If the currency in China gets really strong all of a sudden, I think it's actually going to really affect their ability to export products, and it's going to be a big issue for them. So there's been a lot of debate about this, but China certainly does seem to like to have a weaker currency so that they continue to export products. And this could actually, we could see this happen in Europe. Let's say that the euro continues to get a lot weaker. I'm not sure how low it's going to go, but let's say that it gets to the point where, for $1, you can get 1.5 euros, right? If it gets that weak, which is going to be pretty weak, which is a little bit concerning, then I think we would see lower unemployment rates in Europe, and overall manufacturing would increase, exports would increase because it would be a lot more affordable to import products from Europe if you're in the United States. And then the other sort of pro and con about this is that a stronger dollar is associated with cheaper commodity prices, and so this helps commodity importers, but it hurts commodity exporters. So commodities, let's talk about that just for a second here because it is also a big factor when we talk about currencies. So here is a chart here of commodities, right? And, this is a chart of the US dollar index. The ticker for this is DXY. And so you can see the US dollar basically against a basket of other currencies. And so what we saw happen from the very early 2000s, from around the year 2000, 2001 until we saw the Great Recession in 2008, the US dollar got super weak. And it got super weak for a number of reasons. And we will make a full video about that because it's really interesting. Like the commodities boom in the early 2000s was really, really fascinating. Commodities kind of spiraled out of control. But right now, for example, we see that the US dollar in comparison to oil, it's actually cheaper. Oil's a lot cheaper today than what it was for Americans in 2008. And I think a lot of people don't realize this. This is why I said that gas prices could go to $8 and people could afford it. We wouldn't actually see any demand destruction if gas went to $8. And that's like, I've gotten a lot of flack for saying that, but it's true because in 2008, the dollar was weaker and oil was pretty expensive. I mean, we were paying, $4.50 per gallon for gas. Today, we might be paying that, but it's a lot different because the dollar is a lot stronger and our money goes a lot further. Now, this is the dollar compared to oil, but now let me show you something that's really interesting, which is that, look, since the 2008 peak, oil, Brent crude, which is oil essentially, is basically cheaper for the US dollar. People in the United States and also in China, because Chinese currency has been getting stronger as well. But it's more expensive in places like India and South Africa and Sweden, UK, and in Europe as well. The price of oil is up 20% since 2008 compared to down 20% or down 18.9% in the United States. And this is all because of foreign exchange rates. So this is all just so interesting. To kind of go on with commodities, one more thing I want to add is that we've seen, going back to this chart here, we saw this huge just boom in commodities when the dollar got a bit weaker and commodities got really strong. For example, the price of gold went from $400 to I think almost $2,000 from the early 2000s until 2010, 2011 when it sort of peaked. And this is why I invest some of my money into gold. And so this is kind of just a little sponsor here, but if you want to start investing into gold, you can go check out AppMex where you can buy gold on that platform. So I don't go crazy with it and invest too much money into precious metals, but I think it is nice to have a certain percent of your portfolio, a very small percent, maybe only 1 to 2 to 3% of your portfolio in something like precious metals, because we could see a really big run up if, say, the dollar turns and it starts to get weaker. We can see a really big run up in things like commodities, in precious metals. They would certainly go for a run if the dollar starts to get a bit weaker, which is definitely possible. If we see the euro rebound and we see maybe the Fed starts to cut rates and we see some things happening there, we could see the dollar start to get weaker again, in which case gold and precious metals would be a very interesting play. I don't think it's smart to go in really deep on precious metals because they don't produce cash flow, but it is something that I do like to have in my portfolio. So you can go check out AppMex down below. It's an affiliate link. It kind of just helps fund this video. I didn't have a sponsor in it, but I wanted to include something in here. Let's talk about what's next here. Okay, so what's next? What's going to happen? Is the dollar going to get stronger, weaker? How is this going to affect your portfolio? How is this going to affect the stock market, the bond market? So look, the big question is, how high can the Fed hike rates? How high is inflation going to go? A lot of people think that inflation may have peaked. That's certainly up for debate. But the problem is that the Fed can't crank up rates too high. And we can't crank up rates too high because of a number of reasons. One of them is because we would literally cause the bankruptcy of so many countries in the world. If Jerome Powell did what Volcker did back in the early 80s and, like just absolutely dialed up rates into double digits, I mean, we would basically cause defaults all around the world, and the entire world would basically go into a depression. Now, good thing is, that's probably not going to happen, and people say that the Fed's always stuck between a rock and a hard place, which is very, very true. But the basics is that the Fed cannot crank up rates to double digits, especially very quickly, like what Volcker did back about 40, 45 years ago, because of that big reason. We would literally just absolutely just throw a wrench in the whole world, and everything would come to a grinding halt. There'd be tons of defaults. So we can't do that. But let's say that inflation starts to spiral out of control. That's the big problem. That's the big issue. Now, if inflation starts to spiral out of control, then I don't even know what we do, because we can't dial up rates too quickly. We're kind of bumping them up, 75 bips every now and then. But yeah, so it's really tough to tell. I honestly think that in 2024, and I just tweeted this, and if you want to go follow me on Twitter, there's a lot of interesting stuff on there that I'll tweet out my thoughts and some of the investments I'm making. But I think by the time we get to 2024, we're going to be talking about negative interest rates again. I mean, this is just the chart here of the Fed funds rate. We can see it's been going down for about 40 years. I really can't see us dialing them up a whole lot more than maybe, getting to 4 to 5% at most, and then we're going to start slashing them again. And I think the Fed's just raising rates right now so that they have wiggle room to cut them when we enter into a pretty deep recession at some point in the future. So that's everything right there. That's my opinion on it. So yeah. Okay, so thanks for watching the video. If you found this to be valuable, let me know any of your thoughts. Make sure you subscribe to the channel, drop a like on the video if you appreciate it. Go ahead, follow me on Twitter, on Instagram, and I'll see everybody in next week's video.